How's it going, everyone? In this video, we're going to be looking at a recent video that Ray Dalio has just posted. And he posted this video on whether the stock market is in a bubble, in specific in June 2021. And he looks at 6 key measures to determine if the market is in a bubble or not. So let's quickly take a look at the first measure. The first measure is prices are high relative to traditional measures. So the key way that you can determine if prices are high, first of all, is something called the PE ratio. And we're going to look at the PE ratio of the S&P 500, which basically is 500 large stocks in the USA. So it's going to give you a good feel for overall prices in the USA. So the first thing we need to know when looking at the PE ratio is the average PE ratio across time is 15. As you can see, sometimes in history it goes above that, sometimes it dips below that to around 5. Wish I could have been investing around then. But generally it hovers around 15. Apart from a couple of times in history, if we take a look at 2000, there was an anomaly, right? That was the great technology bubble. And that was, the PE ratio then was around 44. The next time PE ratios got out of hand was in 2008, which was the great housing bubble. And that it got to ridiculously high price levels. And then today, 2021, we see very high price compared to earnings ratios, 46. Now that's 3 times higher than the average throughout history. So that's very high right now. But remember, in the sign, it says prices are high relative to traditional measures. So the other main asset class that we can compare it to, that it can be relative to, is bonds. So we'll use the 10-year treasury bond. Now right now the 10-year treasury bond is 1.5%. So yes, we can say no, we don't want to invest our money in the stock market, prices are too high. But the next best option is 1.5% in a bond. So that's pretty much nothing. Inflation's going to be higher than 1.5%. So that's why, if we look at Dalio's measure, he doesn't say it's directly in a bubble, he says somewhat frothy for the first signal. Let's take a look at the second signal. It's around here. Let's see what Dalio says.
His prices are discounting unsustainable conditions. So unsustainable starts to be part of this picture of a bubble. Unsustainable means that by the nature of the buying, whoever is doing the buying and however that supply demand, that means that that won't be sustained, and that produces a correction.
So the second signal from Dalio is pointing towards no bubble. The third signal is new buyers that have entered the market. Now, this currently is reading frothy, okay? So that's the next worst compared to bubble. It's not as bad as bubble, but it is the next worst option. So why is new buyers entering the market a sign of a bubble? Well, generally what happens after a long bull market run is a lot of people have made money from the bull market. So other people see these people making money and they think, I want to be an investor too. I want to enter the market. Everyone's making so much money. So you get these new investors deciding to enter the market who don't have deep understanding of the stock market as a whole. They don't know what a stock is. They don't know how to calculate intrinsic value. And it is one signal that things are getting overpriced and it's a bit of a frenzy. So that leads on to the fourth signal, which is that there is a broad bullish sentiment in the market, which today also reads frothy. The next signal is purchases are being financed by high leverage. Now, this basically means people are borrowing money to enter the stock market. Instead of working years and years, saving money, and using money that they've earned to invest, they say, it's easy to make money in the stock market. I'm just going to borrow money and put it in the stock market. And right now, this is reading somewhat frothy. The last signal that Dalio looks at is extended forward purchases. Now, basically what happens here is people decide to buy a lot of things like commodities because they're worried about inflation occurring and an economic crisis coming. So that is another sign of a bubble. But right now we don't have big signs of extended forward purchases going on right now. So if we look overall, there's 2 signs of frothy market conditions, 2 signs of somewhat frothy, and 2 signs of no bubble. So we're not in a clear bubble right now, but there are some edgy market conditions. If we look at emerging tech, that points towards a big bubble occurring there. We have 3 of these signs pointing towards a bubble, 2 pointing towards frothy market conditions, and the last one pointing towards somewhat frothy market conditions. So everyone investing in emerging tech and these new technology stocks, hoping to make quick money, don't be so sure that instead of making quick profit, you might end up losing it. So these are the 6 signals that Dalio looks at, and I'm going to let Dalio finish this off. So let's see what he has to say.
Other items are new IPOs, with particularly if they have no earnings, high price to revenue, or in many cases, no prospect of making money. Those are bubble considerations too. So I would say you can't say the stock market is in the highest bubble. You can't even say that it's necessarily in a bubble. You have to distinguish which stocks are in a bubble or have been in a bubble from those that are not in a bubble. There are a lot of stocks that aren't. And that bubble is a little bit like the bond market's bubble. So I hope that gave you a little bit of flavor of bubbles and how I look at them and where we are. Thank you.
So what he's saying is that there are some stocks and some sectors of the stock market that are in a bubble, emerging tech stocks, but others, there's no way you can say that they're in a bubble. Traditional value stocks like food companies or traditional retail stocks, you can't say that they're 100% in a bubble. So you've got to pick your stocks and pick your sectors wisely in this market.